Well, good to see everyone. And I know first up on our agenda, we have our update. I see John there. Looking around to see, and Connor. Hi, guys. Doug.
There.
So I guess we'll just jump right in and would love to hear about these crazy markets right now.
Perfect. Yes. Good afternoon, everyone. Nice to see you again. As you mentioned, I'm joined by two faces that will be familiar to you by now. John Forelli, our head of portfolio research, and Doug Rossi, who is the dedicated client service associate for this relationship. Yeah, it's been since the fall, so fortunately, it's been pretty calm with headlines and markets. Nothing too crazy has been going on, right? It's obviously a lot has changed. When we were last speaking in October, we're talking a little bit about some relative underperformance that we'd been experiencing, mainly due to up until that point, 2024 being led higher by the most expensive names in the market. And, those just aren't names that Boston Partners is going to own. It doesn't fit into the investment approach that we've been using for coming on 30 years now. Since then, in the fourth quarter, we saw that trade start to reverse. In the fourth quarter, we're modestly ahead as a result. And then, that trade really came unraveled in the first quarter, and some sense sort of returned to the market as we saw it. And not to steal John's thunder here, but we did see some nice relative outperformance for the first quarter. What won't be captured in the numbers in the books here is some of that chaos that we've been seeing over the last week or so. I'm sure it's on your mind, sort of where your portfolio is. So we did crunch some estimates for you. And as of yesterday, on a year-to-date basis, this overall portfolio is down about 3%, which, of course, you never want to see red numbers. You never want to see that negative. But when you compare that to some of the headlines of, the S&P 500 being down almost 14% year-to-date, definitely seeing some nice downside protection coming both from, the equity portion that Boston Partners manages in comparison to that equity benchmark, and also some ballast there with the bond ETFs, which you all use. Also, as I'm sure John will talk about, definitely seeing some great opportunities coming from this drawdown. As you can imagine, we've seen a price reset, and a lot of things are now becoming more interesting for us. But I'll let John speak about that more in a few moments. I did just want to quickly go through a couple updates for the firm and the team. Nothing that's going to take more than a minute or two here. Can you all see my screen here?
Yes.
Perfect. Great. This is Boston Partners. As of the end of the year, just due to the timing of the meeting, a couple of these pages will be December 31 rather than March 31. But Boston Partners, as you know, founded in 95. We're coming up on our 30th year anniversary this month, actually, which is exciting. Assets as of the end of the year, about 105 billion. That ticked up to 108 billion as of the end of March. Probably a little bit lower today. The breakdown of those assets is in the bottom right. The equity portion of your portfolio uses our premium equity, our all cap value strategy that has about 11 billion. We have seen some very strong inflows for the firm to start the year. We've seen about 2 billion in net inflows, a lot of interest in how Boston Partners invests. So it's an exciting time to be here at the firm, certainly. Flipping to page 6, this is the investment team. No updates for the folks managing your team. Julio Romalo, still the portfolio manager there. For premium equity, you'll see John there in the second column. One small firm update that I did want to highlight was one of the large cap value portfolio managers, Josh White, was named co-CIO effective in January. So he'll be serving alongside our longtime CEO and CIO, Jay Feeney, there at the top left there. Jay's not going anywhere. This is really about Josh, investor who's been with Boston Partners his entire career, getting some great input in order to ensure Boston Partners is really set up to succeed going forward. So all of his peers are very happy for him, and some well-deserved kudos there. I'll pause. That's really all I had on firm and team. I know you're probably anxious to hear from John here. So if there are not any questions, then I will switch over to performance here, and then we can have John get rolling.
Sounds great.
All right.
Okay, move ahead to page 8. Hello, everyone, again. Let's see. So looking at the first quarter numbers, there are some positive returns. So that's a good thing to say. If you looked at the month of April, then the story would be a little bit different. But you can see for the first quarter, the overall fund net of fees returned about 2.7%. It's interesting to note that both the equity returns and the fixed income returns were about equal to each other in the first quarter. And then also when you look at the 1-year time period, the equity returns and the fixed income returns were about equal. And if you look at the fixed income line net of fees, you can see for 10 years, there were very low returns in fixed income, closer to 1%. So that 4.9% return over the last 1-year period is certainly a departure from the past, as we've begun to see rates at least give us a decent coupon these days compared to what we saw during that zero interest rate environment. You can see relative to the benchmark, that 2.7% return exceeded the 2.25% return of the 50% Russell 3000 value, 50% Bloomberg aggregate by about 44 basis points, and also comfortably beat the 50-50 with the S&P 500, as the S&P 500 by far underperformed the value benchmark this year on a year-to-date basis. And then as you go further out, and you can just see the returns of the fund going out 10 years, beating the benchmark for the overall portfolio of about 124 basis points, with the equity returns being about 100 basis points ahead of the benchmark. And then since inception, beating the benchmark by about 174 basis points, and on the equity portion, beating by about 2.25, and with the fixed income returns being basically right on top of the benchmark over at least the most recent time period since we moved to ETFs. So I think this portfolio is set up pretty well to weather storms like we're having right now in the market, and still give you pretty strong returns, having a balanced portfolio with 7.5% returns over 20-year period now. We hit our 20-year anniversary with you folks. So we thank you very much for the business over that time period. Pages 9 and 10 are basically a carbon copy, but this is for the pension fund and the OPEB trust for page 10. And then page 11, probably the most important numbers for you folks, which is how much money do you have now for your retirement assets. And you can see, looking at the employees pension fund, you initially invested about $26 million with us, have taken out about $5.4 million over that time period for the net investment of about a little over $20 million, and that $20 million has now grown to $114 million. So over our 20-year history, you've made about 5.5 times your net investment, which hopefully that reaches your expectations. And the police pension is even a more interesting story, where you've taken out more money than you initially invested with us. So you have a net investment of a little less than $2 million, but you still have $62.5 million in the pension fund. So again, allowing you to pay your benefits along the way, but still growing your assets along the way, which is really the name of the game. I think that's why you hire managers over the long term. And then you can see the OPEB trust also getting some nice returns over the last 7+ years. From an asset allocation perspective, we can look at page 12, where we currently have about 55% of your portfolios in equities and about 45% in fixed income. Now that we're getting, a 4% type bond yield, it makes fixed income a little bit more attractive than it had been, say, 2 or 3 years ago. And we had increased our fixed income exposure in your portfolio about a year ago or so. And then you can see for all the portfolios, a similar breakdown between equity, fixed income, and cash. Altogether, you have about $192 million invested with us. Page 13, just a quick reminder on our 3 circles process. And I almost feel like handing the presentation over to Kelly because she's heard it so many times. But we're trying to create portfolios for you that have low valuation, low PE ratios, high free cash flow yields. Lower valuation securities outperform higher valuation securities. At the same time, we're trying to buy quality assets, companies with high and improving returns on invested capital. Those companies are getting more profitable and more efficient over time. They outperform in the equity markets. And then finally, if we can find those inexpensive, high quality companies with one last attribute that we call improving business momentum, companies that are meeting and exceeding investors' expectations outperform companies that are falling short of expectations. So we can create portfolios diversified with those characteristics. We think we have a good chance of beating the benchmark like we have done for the last 20 years for you folks. On page 14, just give you a quick snapshot on how your portfolio's positioned as of the end of, or the middle of last week, I guess, the end of March. The portfolio on 2026 earnings is trading at a fairly modest 13 times earnings, compared to the S&P 500 at that time trading at about 18.6 times earnings. You can probably take at least another multiple point off that compared to where we are today with the recent drawdown in the market. Free cash flow yield, which is really important to us. What price are we paying for the free cash that a company's generating? You're paying about half the price that you are for, or maybe 50% less than you are if you were investing in the benchmark itself. So very strong cash generating companies. And you can see from a fundamental standpoint, very high returns on assets and returns on equity. And business momentum has been decidedly positive, where 84% of your holdings have met or exceeded estimates in the most recent quarter. So really, the 3 circle tenants that are typically in your portfolio are certainly alive and present in your portfolio today. Page 15 gives you an idea of how we're positioned today. Top 10 positions make up about 21% of the portfolio. A big position in this portfolio is a 3% position. We currently have 106 holdings in the portfolio, typically somewhere between 100 and 125 holdings in this portfolio. You can see over the last year, the turnover of the portfolio, how often we've traded it, about 20% over the last year, which is about on the lower end of what we've seen historically. During times like we are in right now, I'd say we'd probably get some good buying opportunities. I'd say right now we're being a little cautious as far as turnover goes, because on a day-to-day basis, it seems as though the rules are changing. So we're looking for opportunities, but I would say that we probably haven't taken advantage of many yet. As the entire market goes down, there hasn't been much differentiation in different portfolio holdings. On the right-hand side, you can see how we're positioned relative to the benchmark. So your portfolio is in the blue bar. The green bar would be the Russell 3000 Value Benchmark. You can see a big weighting in financials in this portfolio. Property and casualty insurance are a good place to protect capital in difficult market environments, trading at relatively modest price-to-book multiples, and very good pricing opportunities in insurance companies these days. Also, payment companies, fintech companies, which were favorites of the growth investors about 5, 6, 7 years ago, they've really come down in valuation, and still that theme of all of us using more credit card transactions and more direct payments, that theme is still going on, and the companies are certainly generating lots of cash flow. Healthcare is another area that we favor in this portfolio. Pharmaceutical and biotech companies that are generating lots of cash and trading at very reasonable multiples. The difficulty here is finding some good revenue growth. We found some companies with I'd call modest revenue growth, but trading at very inexpensive valuations. So certainly good ownership for your portfolio. Also, drug distributors. If you've heard about Ozempic or other of those weight loss drugs, the companies that manufacture them are way too expensive for our taste. But companies, the drug distributors need to distribute those, and they've seen an increase in sales as a result of distributing those drugs. So we own the drug distributors in the portfolio, which is a less expensive way to play that trend overall. And then technology would be another area of overweight. Technology might sound a little dangerous today compared to maybe 3 months ago, but we're investing in software companies that have a lot of recurring revenue. We have some exposure to semiconductors, but we've been kind of cutting that back recently. We have distributors, contract manufacturers, basically companies that trade relatively inexpensively compared to the overall marketplace, generating good free cash flow. And then a couple of areas of underweight. Energy is underweight in your portfolio. We've just seen a production increase from the OPEC plus countries. That's going to put some pressure on oil prices going forward. We're comfortable being underweight there. And then real estate and utilities not owned in the portfolio. They really don't fit our criteria. Real estate companies tend to they sell closer to fixed income instruments as far as current yields. Today the business momentum does not look as good in real estate, particularly in office REITs and retail REITs, where we're worried about lease renewal rates going forward. There's still a lot of empty floors in office buildings and empty storefronts. And utilities, being capital intensive and highly regulated, don't really have those three circle characteristics we typically look for. Take a breather there. Any questions on the positioning of the portfolio?
Yeah. Hey, John, can you hear me?
Yes.
It's Eric Bauermeister. Just a quick question. Obviously lots of opportunities maybe being created in the market with the whipsaws. I'm just wondering about the funding. How are you going to fund those opportunities? Obviously there's not a lot of cash in the portfolio. Would you sell fixed income ETFs, or is there some overvalued pockets in the portfolio you could sell at this point? I mean, if you're sitting on a ton of cash, that's easy, but choices will have to be made.
Yeah, it's an excellent question. And we're fully invested, and we will only take money from the equity portion of the portfolio to fund new equity investments. We wouldn't take it from the fixed income unless we thought that equities looked very attractive, more an asset allocation decision. So I'll give you an example of a company we like a lot, but we cut back in the first quarter, is AutoZone, which is an auto parts retailer, very good cash generating company, tends to hold up very well in difficult market environments. So, as the rest of the market has gone down and that's maintained its valuation or even gone up a little bit, we trim a little bit on that position just because it's getting closer to our price target. We're not selling out of the position, but maybe we cut that position in a half or a third, and that would help us fund some better opportunities. And there are certain portions of the portfolio that you get a little bit more nervous about. Electronic Arts, a video game manufacturer, and Take-Two. We kind of sold them both for different reasons, but Take-Two, again, performed well on expectations of a strong launch of their new Grand Theft Auto product, which is going to come out in the fourth quarter of this year. It's coming out another couple of quarters from now. The stock is going up based upon that. There's a lot of things that could happen between now and the end of the year, so we decided to cut back that position. So that's how we can fund it. Typically, funding it through selling stocks that have outperformed in the most recent time period, that are approaching price targets, that perhaps investors have bid up because of the safety aspects of it, but bid them up beyond what our comfort level is from a valuation standpoint. And then, of course, there are going to be time periods where we look at a company and because of the tariffs, we haven't done this yet, but we figure that the business fundamentals are very different from what we originally expected, and we'll sell companies based upon declining business expectations. It's kind of too early to sort that one out because we don't really know what the rules are yet.
Yeah, I was going to say that was sort of a tongue-in-cheek question. How will you analyze that? When will you be sure that the tariffs are what they said they're going to be for a prolonged period of time?
It's an excellent question, and I'd say that's one of the reasons why we haven't done a lot of turnover in the portfolio, despite the fact we've seen the markets go down as much as they have, because There's still a lot of uncertainty out there.
Yep. Okay. Thank you.
Page 16, we can see from a capitalization standpoint how the portfolio is currently positioned. I think, as you're aware, this is an all-cap portfolio, so we take advantage of both large, mid, and small cap stocks, and you can see mid-cap is almost at the peak of where it's been historically, at about 45% of your portfolio, almost equal to that exposure of large-cap stocks. Mid-cap is kind of a sweet spot in the market right now, where we're seeing very good relative valuations compared to large cap. And at the same time, value companies are relatively inexpensive compared to more growth-oriented companies. So that mid-cap portion of the market looks especially attractive to us. I'd say small cap also looks attractive, but in this uncertain economic environment that we're in right now, there's a lot more risk investing in small cap rather than established mid-cap companies. So the risk return for us is better in the mid-cap space relative to small if we're not seeing as many opportunities in the large cap area. And then page 17 will show you the recent turnover in the portfolio, color-coded. So a orange circle would be a new elimination. A green diamond would be adding to would be a new position, and then adding to an existing position would be an up arrow, and a down arrow would be a red arrow there. And overall, you can see not a lot of turnover in the portfolio in the first quarter. This is again before we've seen the drastic drawdown on the market. We felt like we were pretty well positioned coming into this year, probably a little bit more defensively postured than your average value portfolio out there. And I think that defensiveness has helped the portfolio hold up well in this more difficult economic environment. Well, on page 18 shows $30 million, which is about the amount of money we initially invested in the equity market for both the police and the pension fund back in 2005, so 20 years ago. And if we hadn't touched any of that $30 million in equities and we just let it grow, it would have grown to about $207 million. So you would have made, I don't know, nearly 7 times your money over that time period. If you had invested in the benchmark with no fees, you'd have about $138 million. So on that initial $30 million investment, we've created about $70 million of excess return for your portfolios. Again, a little bit of a theoretical exercise, but just gives you an illustration of the value of finding a good active manager and sticking with them for the long term, because there are going to be time periods like 2024 where we underperformed. But if you stick with us for the long term, hopefully we'll help you continue to grow your assets. And just a couple other pages. Again, this is since the inception of the fund on page 19, showing our ability to outperform in months when the market's down versus months when the market's up. And you can see historically about 69% of the time we've outperformed in down months. So protection of capital is really important in the equity markets. But at the same time, we have an equal opportunity to outperform in up months, where 50% of the time we've outperformed there. For an overall batting average of 57%, if you were, I don't know, Jalen Brunson and you hit 57% for your free throws, that probably wouldn't be very impressive. But if he could do that from the three-point line, he'd go down into the Hall of Fame. So let's just see how that 57% compares to other all-cap value managers over the history of our fund. And you can see the returns of nearly 12% net of fees puts us in the 7th percentile of all cap value managers. The information ratio or risk-adjusted returns puts us in the 1st percentile because we create more diversified portfolios than most all-cap value managers, taking less risk. And that batting average, which I showed you earlier, puts us in the 1st percentile of the all-cap value managers. So, another way of looking at the consistency of our returns would be page 21. And this is for the last 15 years. So you've been with us for this entire ride here. And you can see what we're looking is on a monthly basis. We're asking ourselves whether our 3-year equity returns on a net of fee basis are ahead or behind the Russell 3000 value benchmark. If it's a green box, it means we're ahead. If it's a red box, it means we're behind. 78% of the time we've been ahead for an average outperformance of about 1.9%. And you can also see protection of capital. We've never been more than 2.5% behind the benchmark, and we've been ahead of the benchmark by more than 2.5%, about a third of the time during this time period. So we call it tilting the probabilities in the favor of our investors. And, if I could give you one line of what we try to do for you and for all our clients is to create excess returns on a consistent basis. And hopefully we've done that to a degree where you've been satisfied. And we certainly appreciate your business.
Maybe
Yes.
we can, if I flip to page 35 here, Could you maybe walk the group through this page? I think we might be sort of delving into extreme market environment territory, so it might be a good page to review.
Sure. So if we look here, this shows our returns during different time periods during extreme market environments. You weren't with us during the tech bubble, but during the tech bubble, after the tech bubble burst, in essence, our portfolio had a cumulative return of 39% compared to about 5% negative return for the Russell 3000 value. So very strong outperformance there. During the financial crisis, you folks were with us then. We protected capital well. When the market was down 12, we were down 5. After the Brexit scare, that was another area of nervousness in the market, outperformance. And then you most recently during the pandemic, after the pandemic was over, again, very strong returns. I would say this tariff tantrum isn't over yet. But once it is, and we see kind of a bottoming of the market, we typically would fare pretty well in that type of environment.
Hey, John, can I ask another question? If you look at the original fundamental characteristics that you showed us of our portfolio, and this is a little simplistic, so I apologize to synthesize it. It seems like the portfolio is more value oriented than the index is value oriented. Lower PEs, higher free cash flow yields, etc. Is that sort of a consistent strategy across time, or is that just the way it is right now?
Very consistent. So if we looked at our PE ratio or free cash flow yield relative to the benchmark, pretty consistently, you would see it below that of the benchmark.
Right. So the not the trick, but the theme is to be more value than the actual index itself is, all else being equal.
Yeah, I'd say it's the combination of being lower value and higher quality at the same time.
Okay.
And then the last leg of the stool, which we can't ignore, is the business momentum. You know, we don't want to own what I'd call Eastman Kodaks in this portfolio. A
Correct.
company that's really, had dominant market share, very inexpensive, generating good free cash flow, but falling short of investors' expectations for multiple years. That's what we would call a value trap. And we try to avoid those value traps by making sure that the companies that we invest in are meeting our expectations. And I'd say, we can certainly own companies that fall short of earnings expectations. That's not going to kick us out of the portfolio. But if we own a company that disappoints us, say, 3 quarters in a row, very unusual that it would remain in our portfolio.
And would you say the more value, and as long as it's not Kodak, generally outperforms in down markets?
Yes, I would say lower valuation and high quality are both characteristics that help protect capital. And that focus on improving business momentum allows us to keep pace in upmarket environments.
Okay. All right. Thanks.
Yeah. And that's part of, you said the trick, you used the word trick. I think part of the trick to our process is that we're positioned to protect capital in poor market environments, but also to outperform in upmarket environments with our approach. And we can change these dials a little bit depending upon where we are in the marketplace. So if we're in a more of a momentum-driven market, you might focus a little bit more on business momentum. And if you're in a more of a defensive market environment, you focus on that valuation and business fundamentals.
Yeah. Okay. Thanks.
Okay. Anything else we can help you with today?
Anyone else have any questions?
No, you're saying for this month to date, you are outperforming right now, still doing a pretty good job, similar to the presentation overall.
Yeah, so I can tell you numbers as of last night. The equity portion of the portfolio is down about 9.7%, and the benchmark is down about 10%. So we've done a little bit better than the benchmark on a quarter-to-date basis. And then the overall portfolio, this is back of the envelope with the fixed income returns, which have been modestly negative so far on a month-to-date time period. But your portfolio would be down about 5.5% overall this month, based upon what we've seen so far.
Great, thank you.
Great. If there weren't any other updates or questions from anybody, then I think we're good. Thank you so much. Can't believe that we've hit that 20 year. We appreciate the partnership and the returns over that 20-year period. So thank you very much.
And I have to say, I hope Connor's here for the next 20 years to see the next leg of our relationship. I'm not sure I'll be here for the next 20, but I'll be here for as long as I can be, as long as they keep me employed.
Don't sell yourself short, John.
Okay. All right. Well, anyway, thanks everybody, and we appreciate all your business.
Thanks very much. Bye,
Thank
John.
you all
Bye,
so
Doug.
much.
Bye, Connor.
Yeah.
Okay. Next up, I know we have the quarterly invoices. I didn't see any in my packet. I'm not sure if, I know they're usually just for reporting purposes.
We'll have them all for the next meeting, just with all the
Okay.
changes going on around here in finance. We're a little bit,
Perfect.
yeah, thanks.
So then that brings us to the retirement refund applications. The police don't have any this quarter, so it's just for the town. Tony, I know you've taken the lead kindly on this area and wondered if you had any questions or comments to share.
Now, I checked them all and I matched the calculations, so I think we're set. It's pretty straightforward.
Okay, wonderful. Then do I have a motion to approve?
I move to approve.
Okay, Tony, do I have a second?
I second.
Okay, Paul. Okay. Sorry, I saw Paul's hand first.
Darn.
All in favor for the town? Great, unanimous. I know we have a new business that is next on the agenda. Was there something prepared for new business? Or it might be a placeholder from last quarter when we had.
I think that's a placeholder, but Jen, if
Okay.
you want to pop in and do an introduction, maybe we'll count that as new business. How's
There
that?
we go.
Sure, I just wanted to introduce Josh Kaufman, who is our new Director of Finance. So he'll be joining you on a quarterly basis, and I will not see you anymore.
Hi, everyone. Nice to meet you all.
Hi, Josh. Very nice to meet you. Where are you joining from most recently?
The town of New Canaan was where I'm
Okay.
coming from.
Okay.
Welcome, Josh.
Welcome.
Thank you very much.
Okay, so next up on the agenda are the minutes from last quarter. Did anybody have any comments on the minutes? Okay, do I have a motion for the town to approve? Okay, Tony, do I have a second? Eric, all in favor for the town? Great. And then for the police, do I have a motion? Kim? And second, Paul, all in favor for the police to approve? Great. That's everyone. Okay. That brings us to the end of our agenda. So it is a short one this time. How is the remote? It seems like we've now had back-to-back successes in getting full quorum. So I just want to thank everybody for making the effort to be here. And hopefully the remote option is helping to facilitate that. Anything else before we I ask for a motion to adjourn? No, okay. Can I have a motion to adjourn, Paul, with being on both? I don't know, maybe you want to offer for both of us, town and police. Wonderful. Do I have a second for the town and a second for the police? Okay, I've got Tony, I've got Mike. All right, and good to see everybody.
Thank you, Kelly.
Thank you.
Thanks all.
Thanks.
Bye.
Bye.
Bye, guys.